The rest of the world is certainly waiting this morning to see how American traders will respond to yesterday's huge sell-off in China. The benchmark Shanghai Composite Index, closed at 7.6% lower. Stocks in Japan seesawed also before finally closing down 4%. There was a positive sign, though, in Europe, where stocks rose 3% in late morning trading.
So what's the market turmoil mean for us, for our investment? Jane King is on Wall Street with a look at how major companies are responding. Elizabeth Campbell has a look at one silver lining from slumping stocks. But we start with local financial planner Joe Krier. And Joe, it's interesting because you look at what happened yesterday and you look at what happened this morning, and there's a bit of a disconnect this morning.
Yeah, definitely. I mean, yesterday, Wall Street was kind of in panic mode, especially going into the 9:30 hour. This morning, things are quite the opposite, even though Shanghai had a day just as ugly as they did Sunday night. So, Wall Street is sorting through an awful lot of information here and trying to decide whether bad things going on in China are bad enough to drag the U.S. into the mess.
So the big question becomes for us investors, do we react or do we sit back and adopt a wait-and-see posture?
Yeah, this is a situation when it's this volatile. Yesterday was the most volatile day I've seen in 26 years in the business, and you can't react to that. It's really just guessing to try to make moves in the midst of that. It's a matter of letting the dust settle a little bit, let cooler heads prevail, which they will in a day or two, and then make moves and see, who the survivors were and what really is going to work going forward.
People like to put a name to everything, and usually we see a correction after a year and a half. It's been 6 years. Is this a correction? Are we at the beginning of a bear market, or is it too early to tell?
Yeah, in my opinion, this is a correction, and the market was uncommonly calm for most of the year. It hadn't gone anywhere really up or down. It had been in a 4% range for 8 months here, and when that happens, when it breaks out of the range, it's usually going to be pretty extreme. We've had questions about whether this was the beginning of another 2008, and I think not. I think the U.S. economy is in a growth mode, slow but still growing, and the banking sector is holding up quite well. Those were things that really tanked this market back in 2008 when things got rolling downhill.
We know some of the national stocks that we monitor in the course of the Dow, like Apple, which was down to 92 yesterday, suffered some big losses. How about local stocks? I mean, we've got CSX here, Steinmart, Black Knight Financial. Any big impact on those?
Yeah, they moved pretty much along with the averages, 3 to 4% decline. And yesterday was one of those days where there was almost no safe places to hide. Apple at one point was down 13%, and it ended up on the plus side at one point in the day. Local stocks were kind of the same way. So people were just throwing orders in there to liquidate things. They didn't care if it was good, bad, or ugly. And as we started this conversation, that's a kind of market you just need to kind of back off and let it play out a little bit.
Look, I know you work with a lot of local investors, and if you're younger, you sit back and you go, okay, you're in this for the long haul. But people who are seniors and in their retirement years, they tend to be a bit more concerned. What's your best advice for them? Because they're going, look, I lost, 3% of my income here.
Yeah, this is a very difficult market, and making things worse for retirees is the fact that interest rates are so low and people don't have the luxury of going out and buying a 6% CD. So they're kind of forced into stocks that pay dividends, as an example. And, we tend to be just a little more aggressive than we normally would be with retirees. So their exposure is just a little bit more. It's unnerving. Hopefully 3 or 4 years from now, interest rates will be higher. We'll have more choices for retirees where they can kind of lock in some incomes. But for right now, they're sort of along for the ride.
But once again, like you said a couple of minutes ago, it's not like it's 2008, at least yet. Joe Krier, thanks very much. Appreciate you.